Hey guys, Whitney here. Thanks so much for joining me today. We're just going to give it a couple more minutes as people file into the room. We've got an action-packed session for you guys today. I'm so excited to have my dear friends Amanda Hahn and Matt MacFarland here with Keystone CPA. Don't want to kick it off quite yet. We're just going to give everybody a little bit of time to get settled. I know you guys are going to have personal tax questions. I would love nothing more so I can keep things organized today if you guys found your Q&A box, not the chat box, the Q&A box on your bar down below, and drop your questions in there. What we can do is we're going to answer some of those questions that are more general to real estate, especially passive real estate and tax planning around that first, and then we'll save some of the more specific questions to our kind of after party session. So guys, make sure find that Q&A box. All right, guys. So now for the formal introduction. Welcome to the Passive Investing Made Simple Masterclass show. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. For those of you who join on a weekly basis, you'll notice I have a cold. So if you hear me click off the mic a little bit and have a little bit of a coughing fit, sorry about that. We are going to make our way through this today. But this is a live show where we're going to deep dive into all things passive real estate. And today we're focusing on tax planning for 2022. So many of you guys might be going, well, it's only June. Why now? Well, it's because you're 6 months late. Just kidding. I said it first. All right, there you go. Amanda and Matt, you don't have to give that lecture. But before we dig in too far, and I bring in my very special guest, if you guys haven't seen all the other deals that we have going on, or if you're interested in future masterclasses or want to hop on the phone with me and have a conversation around how passive investing could fit into your goals, make sure to go to passiveinvestingwithwhitney.com and check everything out there. Now, to kick off today's show, I want to bring in, again, two very dear friends of mine, Amanda Hahn and Matt MacFarland at Keystone CPA. You guys probably know them from Bigger Pockets and all the writings that they do there. Matt and Amanda, just take a brief moment to introduce yourself and how you got started into accounting, especially in real estate.
Yeah, well, thanks, Whitney. Well, I'm Matt MacFarland, my wife, Amanda Hahn. We are business partners and talk about taxes all the time because we're married to each other. But yeah, we've been in the industry, I don't know, what year is this, 2022? So I'm doing this for 24 years, I guess. Amanda's a few years younger than me, so a little bit less. But, we got our start in Big Four accounting where we, worked in the, real estate group and high net worth individual group and kind of got exposure to a lot of tax planning and with real estate investors. And so that's kind of where we got our, feet wet, for a lack of a better term. But now with our firm, Keystone CPA, probably 85–90% of our clients are investing in real estate, whether it's full-time real estate investors. It could be, people starting off, still working the W-2 job, which is fine, obviously, and they're just kind of investing on the side. We've got syndicators, we've got fix and flippers.
Yeah, and then we have a lot of passive investor clients as well. So kind of see both sides of the coin from the syndication perspective, as well as from the passive investors perspective. Outside of Keystone CPA, we're investors ourselves. So we have small single family, small multifamily that we do. And we are also passive investors in other syndication deals too, with our own money, with our retirement money, which I'm sure we'll talk about a little bit tonight. So tonight, it's today, sorry. Fast forward a couple hours. And so yeah, we're really excited to be here and to answer your questions.
Awesome. Well, let's dive in. Now, most of the people here are passive investors or wanting to start off in passive investing. And so before we get into the tax planning piece, I just wanted to, let's do a quick little recap of the various tax benefits of investing in passively, through a syndication or a fund that all investors should know about, really.
Yeah, I think, outside of taxes, right, as a passive investor, one of the benefits is that we don't have to do too much. It's like you're investing in real estate, you get the benefits of real estate, but you don't have a job, right? Real estate is not your job. You're not in the job of being a landlord or doing management and any of that stuff. So that's the benefit of being a passive investor, which we really enjoy as investors ourselves. And that also translates really well to the tax side too. Whereas when you have your own single family homes, you have to keep track of, your receipts and your expenses and a lot of documentation. You're going to have your CPA who's calculating depreciation for you, or some of the more, advanced strategies like accelerating depreciation. So what's really great about being a passive investor is all that is done for you at the syndication level. So the syndicators or the sponsor group, for the most part, they are already utilizing these strategies so that at the end of the beginning of the following year, you get a nice little K1 that's all packaged up with your tax benefit handed to you. And all you have to do is send that to your CPA, or if you do your own return, you just put that into your tax software. And all of that, hard work is already done for you at the syndication level.
Amazing. All right. So oftentimes when people get their first K1, they see a loss, new investors in a syndication. And they're like, it's negative. I lost money. Is that true?
I guess that could be true sometimes, but I mean, that situation does happen a lot, but whether they actually lost money or not, I guess is but no, generally speaking, what we see happen a lot is, that's one of the benefits of investing in the syndication is that, or, passively investing in syndication. A lot of times you're still going to get cash flow, right? Because the syndication is going out investing in, rental properties, getting cash flow. That some of that cash flow could be returned to you as an investor. So, the investor's thinking, hey, I got a $5,000 check, I'm going to pay tax on it. But then they get a K1 that shows a $3,000 loss or something. And they're like, I'm so confused. I got money. I lost money. What happened here, right? And, but that loss that you're seeing is a result of, one of the benefits of investing in real estate is through depreciation, right? It's kind of that paper write-off where we get to kind of write off of some of the purchase price of the property. Syndication is doing all that work for you, but you're benefiting from it. So it's sheltering your cash flow, right? You're not paying taxes on the cash flow right now. That's one of those benefits of investing in the syndication. So no, more likely not, they didn't necessarily lose money. It's just, kind of one of those things of the way the numbers get tweaked from a tax perspective.
Yeah, and also a lot of times what happens in syndications is you might get distribution checks, right? The distribution would either be like a return of your capital, or it would be distribution of cash flow that was generated during the year. So sometimes for our clients who are the passive investors, they'll say, hey, I got some big distribution checks this year. So can you calculate and tell me how much taxes I have to pay in or set aside to the IRS? And so we always ask follow-up questions like, well, what's the syndication invested in? And if it's, some of the traditional things like rental real estate, right? Multifamily or commercial properties, there's an expectation, at least for us, there's an expectation that the investor likely will not be paying taxes currently on that distribution because of the tax benefits like depreciation and things like that. So I think that's a common misconception. People feel like, hey, I got a check from Whitney's investment, therefore I'm going to be paying taxes next April.
Got a check from Whitney, directly from Whitney.
Yeah.
I'm just doling them out, man.
So do make sure you communicate that with your tax person, because just because you got a distribution check of cash flow or your return of capital does not necessarily mean you're going to pay taxes on that immediately in that year, right? And oftentimes you probably are not needing to pay taxes immediately, which is the benefit of investing in real estate.
Awesome. All right. So let's, that's kind of what happens during the hold. Let's talk about what happens when a syndication sells. I know that's a question that a lot of investors have. We've, gone full cycle on over 6 deals in just the past, handful of months. And they're like, oh my gosh, taxes. What happens now? Like, I got a gain. What do I do?
Yeah, I mean, so, obviously, so fast forward a couple of years, the fund or the syndication sold their asset. And you're going to get, on your K1, you're going to get your share of the company's profit or gain on sale. So you're going to be looking, in an individual level, you'll be looking at, capital gains taxes you may have to pay. Part of that's going to be some depreciation, recapture. But again, the cash that you get from the sale may or may not equate exactly to what your gain is on sale, just because of depreciation and things that happened before. So definitely, hopefully someone is not necessarily preparing their own taxes at that point still, but so that would be definitely a conversation to have with your tax advisors to, here's what I'm expecting, what can we plan ahead for, right, in terms of minimizing taxes.
Yeah, and I think a lot of investors, for people who are not real estate professionals, in the previous years when you were allocated losses on your K1s, what happens a lot of times is those losses are considered passive losses. And if you didn't have passive income, that means your passive losses probably just accumulated and you're carrying forward a loss number. So let's say, for example, every year I had, $10,000 of losses. So over the last 5 years, I have accumulated 50,000 of losses that I didn't get to use before. Now, fast forward, year number 6, I sell my rental property and there's an $80,000 gain because it just performed so well. Well, the good thing is you can offset 50,000 of it with the passive losses that you had. So instead of paying tax on $80,000 gain, maybe your true taxable gain is only 30,000, right? Because again, we have all these losses from the past that we can offset. And the losses might not necessarily be just from this syndication. We see a lot of investors like ourselves who have passive investments, but we also have our own rental properties. And so if your other rental properties that you own had passive losses that you didn't get to use, those could also be pulled in together to offset the gain from the syndication as well. So I think it's important when you have a passive investment and it's exiting, again, don't just have a panic attack and say, my goodness, I'm going to pay all those taxes. First is looking at, do I have some other losses and offsets already that I've gathered up over the years that can help me to offset or reduce some of the capital gains tax?
And where is there a specific part on the tax, 1040 or the tax return that investors can look at, say from last year or this year or 2021 that they just filed potentially to understand if they have those losses?
Yeah, so if they've got some losses that are not, haven't been able to utilize various different reasons, right, tax laws, they would want to look at first place, a good place to go would Form 8582. So that's a form that it carries forward kind of unused rental or passive losses. So that's where I would start. Now, depending on how thick their tax return is, they might take them a while to find it. Our software prints out a summary page at the beginning that shows kind of lists general carryover items. So that would be another spot to look if you have something similar from your tax software or your tax return, if they have kind of report to show here's some carryovers to next tax year. So those would be a couple places I would look for sure.
Awesome. I mean, hopefully people's tax returns aren't like mine.
Yeah, so you'd be surprised, how many pages of tax returns we've actually seen. But yeah, I mean, so even if you're someone who didn't have, losses in the past, there's always other ways to offset the gain too. So for example, if you own other rental properties, you can maybe create some losses, right? Maybe you can do cost segregation or accelerated depreciation on some of the other rental properties that you're currently holding, and you can use the losses from your other rentals to reduce the taxable gain on this syndication that was just sold. You can also reinvest that gain, let's say in another syndication. So my first syndication with Whitney sold, I made a lot of money. Now maybe I take that money and reinvest in a different syndication with Whitney or anybody else. And if that other syndication is doing the similar strategies like cost segregation and creating losses, the losses can also help to offset each other, generated in that year. So effectively, they kind of all go into that same bucket where you can utilize the strategies to offset some of the taxes on that exit.
Yeah, and for those of you who were here a couple of weeks ago, we talked about the lazy 1031.
That's right, the lazy, that's what you called it, lazy 1031.
Yeah, so we talked about it in the boot camp on June 9th, and then also the week before on the Masterclass session. And so you can ping me and I can send you that link, or you can check out our YouTube page, because that's exactly the process that Amanda just described to you. All right, I want to make sure we leave plenty of time. We're getting tons of specific questions like, I've got a property it's selling, what am I going to play with Recapture? Guys, I got your questions. They're here. We're probably going to answer most of those in the after party. However, I want to make sure we leave the bulk of our time, as much as we can, that is feasible, to what should investors be looking to do right now to set them up for the best success for 2022 tax year?
Well, I love that you said, why are we talking about taxes in June? Because, well, you're 6 months too late, right? And that's really how it is. I mean, proactive planning really, is best done as early as possible in the year. So although we're 6 months late, but hey, we still have 6 months left for the remainder of this year where you can do a lot of planning.
Glass half full.
Glass half full, yeah.
Maybe that's a great place to start. I would love to kind of paint this picture because I know when I talk to investors, there's a disconnect between working with their accountant and the person that files their taxes and actually what tax planning is. So maybe let's start there with that kind of like overarching definition.
Yeah. And it's actually one of the most common mistakes that we see people make is assuming that whoever's preparing their tax return is also helping them to do tax planning. I think the thought process is, hey, you're sitting in front of me looking at my tax returns last year. So of course you are already thinking about what I should be doing this year to save taxes. And that may or may not be true. And how do you know if if that's true for you? I think what I would, ask yourself the question, right? What is my plan? Do I have a strategy on how I would reduce taxes for 2022 and maybe even beyond? And if the answer is no, then you're probably one of the 90% of people who really haven't taken the time to meet with your CPA or another CPA to go over what are some possible strategies that you could be doing. And so a lot of CPAs are very busy with preparing tax returns. I think that's most CPAs, right? Because there's law changes, there's just so much going on all the time that there's really not sufficient time to really look at what can someone be doing proactively during the year to save taxes. But that is the more important part of it. How can we save taxes is not something to be looked at in April when you are ready to submit your return for last year. It is actually something that is an ongoing basis that you're doing during the year. So for example, I've invested in a syndication with Whitney. Now there's going to be a gain I'm expecting because it did really well. What can I do to save taxes? And I have the next 6 months to strategize with my CPA or another CPA to look at what are my different options, right? We talked about some of them just now, but which one makes the most sense for you? Or maybe they all are possible options for you, but in what order should we consider them? And the answer to that will be different from person to person who's with us today.
And I think it's, it's along those lines, right? It's keeping the communication open with your tax advisor, strategist, whoever it may be, such that they're not going to know that deal is selling 2 months from now. They're not going to know that you're looking at gains. So it could be as simple as sending an email like, hey, A, B, C, and D are going to happen in the next few months. Anything I should be thinking about, just to get that conversation started, right? Because then you're putting all your ducks on the table, right? And kind of, start planning from there.
Yeah. And I think people, taxes is somewhat scary, or it's intimidating for a lot of people. So I think, a lot of times it's like, oh, okay, you hear, you think it's really good, but maybe after today, they're like, okay, well, yeah, I'm going to think about that later on. So I think as investors, taxes saved is one of the easiest money that you make, right? Because it's your money anyway, you already made it. It's just a matter of how much of that you can keep with proactive tax planning. And so if we can save $10,000 in taxes, that could be a down payment on another, $50,000 worth of real estate. If you save $20,000 in taxes, that could be a down payment for $100,000 worth of real estate. So you can see how powerful it is in terms of helping an investor to supercharge their pathway to wealth building. And so just keep that in the back of your mind, when something's coming up, a decision with respect to real estate investment, should I cash out refi? Should I 1031 exchange? Should I even sell my property? Or is the syndication exiting? Those are times for you to contact your tax advisor because then they can give you the different options, right, to think about to help. It's not your job as an investor to understand that everything is to know about taxes. Like you don't need to know how to calculate depreciation, right? That's just not something you have to understand. But you just need to know, hey, these are times, Whitney's deal is selling and I'm going to talk to my CPA because I want to know what are my options? What are all of the options that are available to me? And we love doing these kinds of educational events because I do see some clients on here with us. And what happens even with our clients too, they'll be like, oh yes, I realize I haven't called you in a while and I need to call you because I just heard you on some podcast.
All right. Well, yeah, you'd rather get those emails now rather than like on March 31st going, what can we do? Help.
Yeah, or December, right? December
Yeah.
is going to be okay. Well, you can reinvest into another syndication and do the lazy 1031 that you heard about, but now you're really in a time crunch. You know, you got to do all the due diligence and you got to deploy that money right away.
And does it close by the end of the year, right? So, are there just a few like high level things that you suggest that people take a look at that are, kind of low hanging fruit that apply to a lot of people?
I mean, for passive investors, like you said, right, generally during the whole time, we don't really have a tax concern because the syndication is already doing the strategies. Can I just call that lazy tax strategies to go off of your term? So it's
Sure.
lazy because we don't have to do anything as the investor, right? The syndicator is doing all of that already. We just kind of reap the benefits. So the thing to be looking out for, typically, like you were saying, is the exit. On the exit, there's typically going to be gain if everything is done correctly, and we need to plan ahead on what are all the different options we have to reduce the gain. For someone who is a real estate professional, we can go into the details of that if you think that's helpful. But for someone who's a real estate professional, it is sometimes possible for them to use their rental losses from passive investments and syndications to also reduce their taxable income from a job or from a W-2 or like a non-real estate type of business. So there's really a lot of value for real estate professional investors to also consider passive investing too. And if you're someone who's not a real estate professional yet, you have the rest of this year to plan ahead and see if there are ways for you or maybe a spouse to try to qualify as real estate professionals so that you can utilize those benefits too.
Well, let's dig into that a little bit more because, I would know majority of the people that are probably on this call wouldn't necessarily qualify for that today. And I know there's a handful here that are like curious, like, what could I do? How could I get to that spot? So can you guys define what the real estate professional actually is? Because it's not a test. You don't have to take a test.
Yeah,
You know,
right.
you don't have to get a degree.
Well, I think a good starting point would actually just kind of explain why it might be beneficial for somebody down the road. So let's say just right now, someone's going investing in real estate and we're maximizing depreciation, and our goal is to, at the very least, we use that depreciation to offset the cash flow so that we're not paying taxes right now on the cash flow. But even better than that is if the depreciation exceeds the cash flow, we've got a loss on paper. We would love to be able to use that loss to offset our W-2 income, business income, whatever else we have going on. Now, the IRS does say that you can, if you make less than $100,000 a year, you can use up to $25,000 of kind of what we call net rental or passive losses to offset your other income. Once you make $150,000 or more, that $25,000 cap goes down to zero. So in between 100 and 150, you can, it phases out, right? But so once you reach $150,000, unless you can qualify as a real estate professional, generally speaking, any net losses you generate from your rental properties, you can't use to offset other types of income. So that's where a real estate professional can come in handy, is if you have more than $25,000 in losses or you're making more than $150,000.
I do want to clarify. So if you are someone with, higher income and you're not a real estate professional, it doesn't mean you lose out on those losses. Right. They do carry forward, which is kind of what we talked about earlier. They're passive losses. So they do get to carry forward to offset future passive income or, capital gains income from sale of real estate. So you don't ever lose it. It's just a matter of timing. But also, if you happen to have other passive income, like you have other passive syndication investments or in other passive businesses, you can utilize those regardless of whether you are a real estate professional or not. But maybe you can talk about the definition.
Yeah, so to be a real estate professional, and this is going to be in regards to your long-term rental properties. A couple of things the IRS looks for is, one is that you have to have more than 750 hours per year in qualified real estate time. You need to have more time in real estate than you do in any other job that you may have. So if you're working a part-time job and you're spending 1,000 hours a year in that job, you need to have 1,001 hours in real estate to meet that test. And then the third one, which is just equally as important, is that you need to meet one of what they call the material participation tests with respect to your rental properties, meaning, layman's terms is you're very involved in the day-to-day operation of managing your rental properties. Now you can have property managers for some, but you need to be really involved in doing a lot of the day-to-day stuff of your rental properties. And there's there's different ways to meet the material participant. There's a 500-hour test or some other tests you can meet if you can't get there. But so those are the 3 tests. Again, 750 hours, at least 750 hours, more time in real estate than your other jobs, and you have to meet one of the material participation tests. But if you can do that, then if you are generating losses from your rentals, you can use those losses to deduct in the current year against all other sources of income without any limitations.
Mhm.
And if you're married, do both people have to meet that real estate professional status?
So if you're married, obviously when you're filing a joint tax return, you're both going to benefit from one of you meeting these tests, right? But as a real estate professional, your spouse's time can, believe it or not, your spouse's time can help you meet that material participation test, but it cannot help you read the 750 hours and the more time in real estate than your other jobs. So, great, perfect example would be 2 spouses, one's working a W-2 job, the other one's doing real estate all the time. So that one doing real estate doesn't matter how many hours their spouse does in their W-2 job because that's not their W-2 job, if that makes sense.
Mhm. Yeah. And the benefit is that once one of you meets real estate professional status, then both of you will get the benefit, right? Both of you get to utilize rental losses to offset other.
Assuming you're
other
filing
types of
joint tax
income.
return, which most people do, but.
Awesome. Okay. And I mean, I know that's such a powerful, trick that I learned, and but it's not open to everybody. And I know when I talk to investors, they're just like, oh my gosh, if I can't become a real estate professional, I'll never be able to retire off of passive real estate because I'll never get the tax benefit. Well, circle back to the beginning of this conversation, and guess what? You get all the tax benefit by investing passively. So
yes, and that's such a, we hear that all the time, and I think it's such a misconception, and it's unfortunate because I think even a lot of CPAs and tax advisors tell clients that, they'll say, hey, yeah, you heard about all the great things in depreciation, but you don't get any benefit. So we always get questions like, oh, I'm not a real estate professional, so I don't get depreciation, or I can't write off my car expenses, or I can't have a home office. And that's not true at all. The deductions are the same, regardless of whether someone's a real estate professional or not. The only difference is the timing of when you get to utilize that benefit to offset what types of income. But so it's never like, oh, because you're not a real estate professional, you don't get any tax benefits. You just might not see it immediately against like a W-2 income, but rest assured it is being accumulated, and you will at some point utilize that benefit. In our example, earlier today, when one of the syndication sells for a gain, you will get that benefit.
Awesome. So question came in that kind of fits in here is, what happens with the recapture? Like when a syndication sells, depreciation recapture.
What happens with depreciation capture on a syndication sale? So yeah, so depreciation recapture is part of your overall capital gains. It's just going to be taxed differently than regular capital gains. So good way to look at it is like, outside of the syndication, just kind of key. Let's say you have your own property, you buy for $100,000, you take $50,000 depreciation on it. So your tax basis goes from 100 down to 50, right? But you sell it for 125. So 125 minus your tax base, you got a $75,000 gain. Well, the first 50 of that is because of depreciation you took. The other 25 is because of the actual appreciation in the property value. So that 50 grand is what we call depreciation recapture, tax generally, 25% for federal purposes. The appreciation, the capital gains part of it, is going to be taxed either 15 or 20% depending on your tax rate. So it's you're still going to have to pick up depreciation recapture, but just might be at a slightly different rate than the rest of it.
Okay. And then you can offset that with new depreciation.
Yeah, I mean, the depreciation recapture, the capital gains, that can all be offset with other passive income you have, passive losses you have from other syndications. It could be you're going out and investing in a new one before year end, and they're going to kick off a bunch of depreciation for you. That can be used to offset that for sure.
Awesome. Awesome. Now we haven't talked much about the IRA, and there was a question that came in. So I want to make sure that we touch on this. And then I think we're going to wrap it up and then, dive into kind of more of our after party questions. But I had a listener write in.
Is there drinks in the after party, or is it just questions?
You have to answer questions in the after party.
No drinks, he said.
Oh, no drinks. Sorry.
Not that kind
I'll
of
mail
party.
you one next time, Matt. How's that? If I withdraw 100K from an IRA and there are no gains loss on operations, but say $50,000 depreciation loss, can this be offset against the withdrawal?
So if you take 100 grand out of your IRA and you nothing else going on, you got a $50,000 loss from a rental property.
I'm going to assume this IRA, so this depreciation is in a rental not owned in the IRA.
Probably a safe assumption.
So because it's a, just I have a rental with depreciation, I withdrew.
So if you're not in that situation, if you're not a real estate professional, then you would be able to probably use $25,000 of depreciation loss to offset the $100,000. But again, they cap it at $25,000 max. So you wouldn't necessarily probably use the whole 50 grand in that situation.
Mm-hmm. And this also assumes that this depreciation we're talking about is not from a passive syndication investment, just like maybe like your own rental property or something like that. If you are a real estate professional, then yes, all of that would offset. Your depreciation from a rental can offset retirement distributions.
So many, it depends.
I know, sorry. It's a one question.
Yeah, and I think I think that's like a great point to illustrate here. Is that, I mean, I love attending like these online webinars myself because I always like learn some pearly wisdom, but at the same time, I can't take that nugget and necessarily apply it to my situation because of it depends, right? There's so much missing color there. So it kind of leads me into like a couple of my wrapping up questions is, listeners here, what is something they should stop doing right now and in preparing for 2022, and something they should start doing in preparing for 2022 tax season?
Stop doing, gosh, I think if you haven't already done planning, would stop procrastinating. The earlier you do it, the better it is. And, I think just like I said, most people have a fear of taxes or intimidated by taxes. So stop feeling that way and start seeing taxes as your friend. It's one of the easiest ways that you can make money by keeping your money, right? By keeping more of what you make. So definitely stop being afraid and start taking action and getting a plan in place so you know how you can save taxes for this year. I would also say start paying attention to proposed law changes. I know that's probably a hard one because there's always a bunch of different proposals, but also that's what we're here to do. Always like we always try to do webinars and kind of educate people on what's coming down the pipeline, what the proposed tax changes are. One thing, for example, there's proposals about limitations to 1031 exchange. So right now we can do 1031 exchange with no limit, right? I can sell $1 million worth of real estate with $1 million worth of gain. I can 1031 exchange into, other real estate and defer all the tax. One of the proposals is to potentially limit that. So you can only defer up to $500,000 worth of gain per taxpayer per year. So, something that we're keeping our eye on. If that were to become law, I think it's something that we need to be able to act quickly. And so what is something to do is right now is to look at your portfolio and trying to look at what are some properties that maybe I don't want to hold on to for the long term, something I might want to reposition or exit in the next year or two, and thinking whether it makes sense to do it now while there's no limitations on the 1031 exchange, right? Because that very well the facts could really change next year if something like this were to become law.
Very good. Very good. All right. Where can our investors find you if they want more tax support?
Our website is the best place, I think, to find us. We try to do tax updates as frequently as possible in terms of what's coming down the pipeline and just provide some additional information regarding tax strategies. We also have a free downloadable ebook. It's called Tax Strategies for Real Estate Investors, where you can find out more information about how to legally shift income by paying your kids and taking a tax deduction for it, what you should be thinking about when you're deciding whether you should have a legal entity for your real estate. And we also talk about real estate professional status a little bit more in depth as well. So you can download that ebook on our website too.
Awesome.
And it's keystonecpa.com.
Thank you.
We're just teasing you.
Just website, find it.
All right, guys. Well, if you're Matt, Amanda, thank you so much for joining us live today. Guys, if you're here live, don't go anywhere. Matt, Amanda, don't go anywhere either. We're about to start our after party session. If you're listening to us on your favorite podcast of choice, just make sure to reach out to us at passiveinvestingwithwhitney.com. There you can get registered for future masterclasses and check our open deals. Till next time, guys. Well, thank you.